Coming up on today's program, World Bank unveils Next Generation Africa Climate Business Plan. Kenya and Morocco to represent Africa in the United Nations World Tourism Organization. Plus, Ghana's economy contracts 3.2% in the second quarter of 2020. We're glad to have you on Business Incorporated. Thank you for joining us. I am Bisi Adebayo. But let's kickstart the show with market numbers coming from Africa, which were all in the red at intraday. In South Africa, the JSE index shaved off 1.49%, while Nigeria's main index was marginally lower by 0.05%. In Egypt, the EGX30 declined 0.28% at intraday, and Kenya closed negative on Wednesday. Well, it's a different story in the Middle East. The sentiment in major markets there were all positive at intraday. In the UAE, Dubai's main index jumped 0.32%, while the Abu Dhabi index was marginally higher by 0.07%. Elsewhere in the region, Saudi Arabia's index rose 0.16%, while the Qatari index added 0.06%. Well, breaking news coming from the UK is that the Bank of England has voted unanimously to leave UK interest rates at their current record lows at 0.1%. Well, let's get more on this from Juliana Olayinka, who's standing by from our London studio. Good afternoon, Juliana. Well, just like many had predicted, the BOE has voted to maintain status quo on interest rates at 0.1%. What reason did the bank give for this decision, and how are the markets reacting?
Well, the pound fell sharply. The FTSE also fell lower. But to be fair, as you just said, Bissy, this is what was to be expected. This is the second Monetary Policy Committee meeting in a row where further monetary policy has been put on hold. Interest rates remain at a record low of 0.1%, and bond buying stays the same at £745 billion. Now, the Bank of England did say that, and of course they've got a forensic look at the economy, that the activity of the British economy is picking up, but there are still some major concerns about the second wave of the coronavirus. I spoke to Chimazi this morning actually about the northeast of England. 2 million people have been put into a lockdown, and there are growing concerns that potentially this could be a nationwide lockdown in the next couple of weeks. We're not hearing much from Downing Street rebuffing these rumours, and so I think a lot of investors are really are not sure about that, and the Bank of England want to make sure that they do stimulate the economy at the right time and not prematurely. One of the other things they mentioned is that they expect the British economy to shrink by 9.5% this year, and that in 2021 they expect growth to be at a rate of 9%, so still of course below those pre-COVID levels. They did say that we have seen an uptick. I believe we are 18.5% better economically than we were in April, but still 11.5% down if we compare it year on year. So let's have a look at those numbers then. The FTSE All Share is down 0.87%. The FTSE 100 is down 0.96%, and the FTSE 250 is down by 0.60%. In currencies, the pound is up on the US dollar by 0.01%, although it's slightly lower at the moment, up on the euro by 0.18%, and down on the Japanese yen by 0.17%.
Now, the war of words between the UK and the EU on their post-Brexit relationship, of course, continues as the PM Boris Johnson keeps trying to push his internal market bill through the UK Parliament. What's the latest regarding this?
Oh, well, the latest is that the internal market bill has passed the Commons vote. It passed that on Monday, I believe by 77 of a majority. It will go into the second reading next week, and it's really next week which is a huge battle for Prime Minister Boris Johnson. We do know that overnight and over the past couple of days he's been speaking to a series or a number of backbenchers who want to be rebellious and have decided that they would be voting down the internal market bill. Just to remind our viewers, this piece of legislation would basically alter the withdrawal agreement that was signed yet less than a year ago to negotiate our exit from the European Union. Once that was signed a year ago, it was signed into international law. So for Boris Johnson to go against that or to try and rewrite parts of that would be breaking an international convention. And of course, that's got people up in arms, not only in Brussels and in America, but domestically too. We've had all of the former living prime ministers condemning Prime Minister Boris Johnson's act. So he's really, some would say, trying to backtrack, trying to make sure that his Tory backbenchers understand that this piece of legislation will only be used if a deal cannot be struck with the EU. Some say even then it's something that the government shouldn't do. So that's kind of where we are. I think a lot of observers, a lot of political commentators here in Britain are saying the biggest hurdle that Prime Minister Boris Johnson will have is in the House of Lords. A series of peers who sit in the House of Lords have said that they certainly will not be agreeing or accepting this internal market bill, particularly some hard right, staunch Brexiteers who have condemned Boris Johnson's plans. But so far, I don't want to say so good, but so far so good, because of course it's passed up until the second reading. So the next battleground for Prime Minister Boris Johnson will be next week.
And we'll see how that goes. Well, just before you leave, Juliana, tell us now, audit firm Deloitte has been fined a record £15 million and been severely reprimanded for failing in its audits of the software company Autonomy between January 2009 and June 2011. What more do you know about this issue?
Well, this information is just coming in, and as you said from those dates, this is a long-running battle that goes back 10 years. Regulators have described Deloitte's overseeing of Autonomy's accounts as botched. The Financial Reporting Council accused Deloitte, and particularly two former senior partners of Deloitte, as being too cosy with Autonomy when they were trying to, or they were supposed to be looking at their accounts independently, and they allowed Autonomy to really beef up the states of their account when really they were in tatters. The FRC says that Deloitte allowed the former tech company to hide £118 million of loss-making hardware sales before the company was sold to Hewlett-Packard for £9 billion, and then Hewlett-Packard had to completely write off Autonomy's value when they had a closer look. Now, this £15 million fine is the biggest fine that the FRC have ever given to one of the big four accounting firms. And it's really because Deloitte tried to, deny all of the allegations until, of course, it was brought to court. So this has been a reward that's just been announced. And yes, £15 million, the biggest fine the FRC has ever given to an accounting firm in this country.
I can only imagine. Thank you, Juliana. Do enjoy the rest of your day. Well, let's turn now to Europe, where stocks actually retreated this morning as investors around the world continue to react to the latest U.S. Fed Reserve meeting. Well, Chelsea Delany is standing by at the Frankfurt Stock Exchange to tell us more. Good afternoon, Chelsea. European stocks were under pressure with the central bank meetings in the U.S., Japan and the UK driving the markets. What are the investors taking away from the latest policy decisions?
Well, I'd say that the decision from the Federal Reserve is definitely the main driver of markets today. Investors do appear to be a little bit disappointed about what they heard from the Federal Reserve yesterday and from Chairman Jerome Powell. A lot of people had been expecting a slightly more aggressive stimulus push from the Federal Reserve, given the economic conditions. Right now, the Federal Reserve seems to be saying they're going to have to wait and see how the economy develops before they, push the gas on more stimulus. They've already rolled out trillions of dollars of support for the U.S. economy, and it's a bit unclear what more they could do with interest rates so low, with bond buying so high. So for now, they do seem to be taking a step back, but they also are acknowledging that the economic outlook in the U.S. has improved slightly. They basically halved their forecast for the recession that's expected in the U.S. this year. They do expect unemployment to come down by the end of the year. But we also heard from Jerome Powell a lot of discussion of the uncertainties facing the U.S. economy. There could be potentially long-term effects that we're not really acknowledging right now for workers, for certain industries that have been hit particularly hard. So that's certainly a concern for investors, and it also really mirrors what we've heard from the Bank of England and the Bank of Japan, just a lot of discussion over the uncertainties and the potential risks facing the tepid and early recovery that we've seen in the global economy so far. And that's really weighing on investors a bit today.
All right, Chelsea, another issue probably that investors are weighing on is the new data released today, which show that EU car sales slid 19% in August, and that's after having recovered over the summer. Why has the rebound in car sales suddenly stopped?
It's a bit of a shock. Obviously, after lockdown measures were lifted here in Europe in May and June, in July, we did see a pretty strong bounce back in car sales. So at some point this year, in April and March, car sales were down something like 75%. We haven't seen things like that since then. People have gone back into dealerships. People have gone back and started buying again. One part of that is that a lot of governments in Europe have rolled out incentives for buyers. So France, for example, had a $5,000 premium that people who bought new cars would get. So that really did help drive up sales. But a lot of those subsidies are starting to expire. France's subsidy, for example, expired at the end of July. So that could be one reason why we're seeing demand for new cars start to fall off. At the same time, a lot of countries in Europe have started to see an increase in infections in places like France and Spain. There's a lot of more discussion about potentially locking down some neighborhoods, some areas of those countries, and that could also be weighing on sentiment. But for car makers, this is a bit of a blow, and we're definitely seeing that in the reaction of investors. We've seen stocks of companies like Volkswagen and Daimler really fall today.
Now, this has also been in the news for some time now, and I'm talking about the drama over China's video app TikTok, which continues with just 3 days to go until the U.S. President Donald Trump's deadline for the company to sell itself or be banned. Now, what's the latest on TikTok's plans in the U.S.?
Well, the latest is that they're really still no closer to an agreement. If you'll recall, this has been a pretty complicated story, but basically the United States had threatened to ban TikTok in the United States over security concerns unless TikTok, which is owned by a Chinese company, sold its U.S. business to a U.S. company. What the company instead has proposed is that they would take on some U.S. investors, Oracle, the software company, Walmart potentially, and that they would hand over the data that they collect to Oracle. That has so far not really appeased the White House and President Donald Trump. We've heard over the past couple of days since this proposal went public that he doesn't think that the company should be still majority owned by a Chinese investor, a Chinese company. They really want TikTok to be in U.S. hands, and the proposal they've gotten so far just doesn't live up to that. So for this deal to go through, it does have to be approved by the U.S. Beijing says it also has to be approved by Beijing. These are very complicated issues, and the ban could potentially go into effect on Sunday. So they're really coming under the wire here, and it's unclear which side is really going to blink first and bend on these very difficult discussions.
Thank you, Chelsea. We'll see you tomorrow. Now let's talk about stocks in the major Asia-Pacific markets, which are mostly down today as investors reacted to central bank developments. Hong Kong's Hang Seng Index led losses among the region's major markets as it fell 1.56%, while South Korea's Kospi shed 1.22%. Mainland Chinese stocks were mixed, with the Shanghai Composite down 0.41%, while the Shenzhen component was above the flat line at about 13,015.19. In Japan, the Nikkei 225 slipped 0.67%, and the Topix index dipped 0.36%, and in its trading day at 1,638.4. And in the U.S., stock futures were mostly lower this morning as traders digested the Federal Reserve's pledge to keep rates low over the next few years. The Dow Jones Industrial Average were up 0.13%, and the S&P 500 and the Nasdaq 100 futures traded in negative territory. Members of the Federal Open Market Committee indicated the U.S. overnight rate could stay anchored to the zero bound through 2023 as the central bank tries to spur inflation. The World Bank has unveiled the Next Generation Africa Climate Business Plan, a detailed roadmap aimed at helping countries in sub-Saharan Africa to address climate change and poverty. The plan calls for countries to seize the opportunity to scale up climate resilience to grow their economies and reduce poverty, redouble efforts to increase energy access, and take advantage of sustainable and innovative approaches to leapfrog into greener development pathways. The World Bank will focus on 5 key areas, namely food security, clean energy, green and resilient cities, environmental stability, and climate shocks as part of the plan over the next 6 years. Kenya and Morocco have been appointed by the United Nations World Tourism Organization to represent the Africa Technical Committee on Tourism Online Education. The two countries were appointed during the organization's Executive Council in Georgia, which hosted 170 delegates from 24 countries. The 112th Executive Council is being chaired by Kenya's Tourism Cabinet Secretary Najib Balala and is aimed at giving insights on the solutions that will shape the future of tourism towards innovation and sustainability. Let's talk about the domestic commodities markets now. Well, just before we get to the domestic commodities now, data released by the Ghana Statistical Service shows that Ghana's economy contracted by 3.2% in the second quarter of 2020 compared to the same period in 2019. Ghana's non-oil gross domestic product, which measures productivity within the economy, also shrunk by 3.4% within the same period. The government statistician, Professor Samuel Anim, attributes the economic contraction largely to the coronavirus pandemic, which brought economic activities all over the world to a standstill. Professor Anim says one of the major drivers of the contraction was the manufacturing subsector, which shrunk by 14.3%, given that it had the second highest share of 11.3% across the 22 subsectors, including cocoa and oil and gas. Now, fish makes up about 40% of Nigeria's protein intake and is consumed either fried, dried, grilled or boiled, and it produces in excess of 1 million tons in addition to imports. Nigeria intends to ban fish imports by 2022, but at the same time, fishing is constrained by environmental pollution and degradation in aquaculture-intensive states like the Niger Delta, and this has led to dysfunctional activities of the youth in the region. But let's talk to Dumebi Iyeke, a research analyst at the Financial Derivatives Company, about this. Good afternoon, Dumebi. It's good to see you again today. Now, recently, the price of fish fell by 14.3% to about 1,200 Naira per kg from the lockdown price of 1,400 Naira. Tell us what's responsible for this and how, of course, it will affect the price of other protein substitutes like beef, chicken, or even turkey.
Well, BC, fish is one of those commodities that Nigerians are very adventurous with. There's several. A popular delicacy is the fish pepper soup. But just like other commodities, it has to be consumed in moderation to avoid health complications in terms of high cholesterol. Now, bringing this to the price of fish in the domestic market, a popular fish, mackerel, which is also known as Titus in the market, the price has declined significantly compared to the lockdown period, and this is because the economy is reopening, and now there's an increase in supply of fish to the domestic markets compared to that period. In terms of the effect on other substitutes like chicken or beef, the impact has not been so large or very intense, and this is because the price of all these other substitutes are also declining. So consumers are faced with the option of, either take fish or take meat or take beef. So they're not constrained in terms of options because the prices of all the substitutes are declining, including fish.
Now, of course, we know that because environmental pollution has drastically reduced the supply of fish and made the waters uninhabitable by aquatic species. But what effect will the ban and the fall in production as a result of environmental pollution have on the level of Nigeria's protein intake and the price of fish?
So, BC, we're looking at two major effects here. And we're looking at the effect of the ban, and we're also looking at the effect of lower fish production in the country. And we can't take these two scenarios or these two issues in isolation. The first thing we need to consider is the fact that Nigeria's fish production is still suboptimal, and we have a domestic demand of over 2 million tons. So there's clearly a demand gap which imports, service. And if the import ban, is implemented and production is still at current levels, what we'd likely see is a spike in the price of fish. And in terms of protein intake, fish protein intake, accounts for about Nigeria's protein intake. About fish accounts for about 40% of Nigeria's protein intake. I'm sorry about that. And if there's a decline in the production of fish, and there's an increase in the price, so protein intake from fish, would likely decline. Although this might be offset by an increase in the demand, for other substitutes like chicken, fish, as consumers move towards other commodities to substitute for the absence of fish.
But then there's a positive correlation between protein consumption, life expectancy, and the average literacy rate. So what do you think will be the direct and indirect effects of the reduction in fish output and the ban of fish imports on life expectancy and literacy rates in Nigeria?
Well, we see science has, shown that there are health benefits for the intake, for the consumption of fish, and not only fish, but having a high protein diet. The health benefits span through different areas. And in terms of we're looking at this in terms of increase in immunity and increase in brain activity. So in economic terms, we're just saying that a high protein diet, would increase literacy rate and life expectancy rate. But in the case of lower production of fish, we're saying that there could be a decline, there would be a decline in the protein intake of Nigerians, and this could likely, affect the literacy rate and the life expectancy. But if we look at the fact that consumers could actually, substitute their protein consumption, from other sources like egg, milk, chicken, and turkey, so the effect might not be so much in terms of the impact it will have on literacy rate and life expectancy.
We'd like to thank you, Dumebi Yeke, research analyst at the FDC. Thank you for your input on the program.
Thank you.
And that's where we wrap up today's show. Thank you for watching. I am Bisi Adebayo.